Bonds and portfolios have been nothing but a disappointment for many investors over the last decade. Some fund managers now expecting a big resurgence. Our Christina Partsinevelos has that for us this morning. Christina?
Well, Scott, fixed income yields have been so low over the last decade. We know that. Even negative in some cases, like in Japan still now. But it's been a tough go for bond investors to find value. But the bond resurgence is upon us.
I have never seen really a better opportunity in the bond market to get into the bond market than I have right now. And that's in my whole career.
A new Bank of America fund manager survey for December shows investors are actually overweight bonds relative to any other asset class for the first time since 2009. Why? Well, we know yields have steadily climbed, resulting in higher interest rate payments, and those yields are expected to stay high in 2023 as the Fed has signaled no immediate pivot until inflation falls and the labor market weakens. Even if inflation comes down a little, it's not expected to be majorly dramatic and result in a pivot right away. So given that Fed uncertainty, expert at Deutsche Bank, Bank of America, U.S. Bank Wealth Management all suggest sticking to shorter-term fixed income assets.
Our perspective is just, be fairly tight to benchmark, shorter in duration as we get into the first quarter of the year. We'll see, this interplay between the Fed, inflation, and the economy and see what that sequencing looks like.
So for investors watching, that means you can look at Vanguard's Ultra Short Bond ETF or the iShares Short Treasury Bond ETF. Those are two that you're seeing on your screen right now, both with dividend yields of almost 1.4%. And then you have Citi analysts that say that many are still even missing out in the explosion of corporate bond ETF options. IG, LQD track investment-grade corporate bond markets. You can see they're on your screen as well, too, with their yields and offer yields both above 3%. You can see the principal investment-grade corp, that dividend yield is over 7%. And I know I'm talking about bonds and ETFs that, track the market. They may be sleepier than crypto or new tech offerings out there, but they do offer stability as we head into a very uncertain 2023, guys.
Yeah, Christina, and stability, I think, might be the way to think about it. I do find it interesting that there's almost this novelty factor. People who for, almost a generation aren't used to the availability of safe yield are saying, wow, look at this. I can have this as a cushion in my portfolio. But also probably worth keeping in mind that if you are afraid of a recession, bonds could probably finally act as a hedge against other risks that you might be holding, as opposed to just, saying, oh, I'm getting 3% as a way of getting some income.
Yeah, excellent point, because we really saw that relationship between equities and bonds fall apart, especially in 2022 with the sell-off. And so a lot of these experts, of course, they're going to be bullish bonds because that's what they cover. They're saying that finally that relationship that we know of, when the markets tank, you're going to see bonds go, or people get back into bonds because it's a safer bet. So that is the reason why they're saying this relationship is going to come back. You have several fund managers, Bank of America, all of them are saying for the first half of the year, bonds is where to go, and then the second half of the year is when you should be pivoting back into equities.